Hello everyone, welcome to the first of our ACCA F9 lecture recaps. This is a recap of our full course lecture on financial strategy. If you want to download the mind map as a PDF for free, go to our website. You can download all of our mind maps for free, or you can purchase the full course should you wish to do so. So the first thing that we looked at was planning. So what does the financial manager plan? We said they plan three things. First of all, they plan investments, and they may be short-term investments or long-term investments, and we discussed those. We also said that they need to plan financing. How are you going to finance those investments? Two ways: debt or equity. Debt in the form of bonds, equity in the form of shares, or indeed debt in the form of bank debt as well. And we look at those in detail throughout the course. We then need to think about dividend policy. That needs to be planned because we need to know how are we going to distribute all the lovely profits that we're going to make from our investments. So those were the three things that we talked about planning. We then need to understand our strategy for the business. We need to know how we're going to get things done. First of all, at a corporate level. Corporate strategy, remember, involves thinking about new markets or current markets. Business strategy, remember, this is at a slightly lower level. We're thinking about the business units and our competitive position in the market. And lastly then, operational strategy. An operational strategy, we said, was focused on the functional areas of the business, particularly because we're thinking of finance, the finance units and how they perform. So that's what our strategy is. What are our stakeholders? Well, we said that stakeholders are anyone who has a legitimate interest in the business. It has to be a legitimate interest. We broke them down into internal stakeholders, who we said were managers, employees, those types of people, and also external stakeholders. External stakeholders were people like investors in the business, the community at large if they're affected by the business, banks who lend to the business, the government who want their taxes and who want regulations abided by, also customers and suppliers, very important external stakeholders. All of these have a legitimate interest in the business. And remember, they may have conflicting objectives. And we talked about the agency problem, how shareholders have long-term objectives. They want to see stability in the business and long-term returns, whereas management are interested in short-term gain. They want to make as much money as they can, their bonuses, etc. And those two goals are not aligned. So we had to see how can we make those goals come together through goal congruence. We need to make the management objectives longer term, and that might be through share options. So that was the agency problem. We also talked a little bit about profit as against community and environment objectives. We moved on then to financial objectives. Remember, the main number one financial objective was to maximize shareholder wealth, and that was share price growth and dividends paid. That's shareholder wealth. And we did a detailed example of this. We worked through year on year shareholder wealth increase and looked at how that could be done. We also said that maximization of profit was another financial objective. However, remember that profit can be manipulated, so we'll often use cash flows. EPS growth was the final one, and we said it's profit after tax less preference dividends over the number of ordinary shares. Remember, the top line is the distributable profit, the bottom line is who it can be distributed to. And we did a detailed example on EPS growth. Our non-financial objectives, well, remember, you need to be specific to the scenario, and you need to think about things like growth, research and development, service, quality. All of those will be non-financial objectives that a business may try to achieve. That brought us on to dividend policy, the third of the three things we need to plan as a finance manager. We talked about the options that you can have, the constant dividend you could pay without changing, or you could pay a constant proportion of earnings so that the dividend moved with your earnings. We also talked about inflation-linked dividends as a possibility. And we also mentioned that you could pay what's left after you've made the investments that you want to make for that year. There are advantages and disadvantages to each of these, and we discussed that in the full lecture. Dividend irrelevancy theory. This was put forward by Miller and Modigliani. Remember, they focused on maximisation of shareholder wealth. So what they said was that the business had a choice. It could either pay a dividend, in which case the investors would get their return. They would get it in the form of that dividend. Or you could reinvest the earnings in the business, in which case this should lead to share price growth. Because you invest in a profitable project, it should lead to share price growth. Both of those will maximise shareholder wealth. Either they'll get a dividend or they'll get an increased share price through the reinvested earnings. So they should maximise shareholder wealth by the same amount, and therefore dividends are irrelevant. So that's what Miller and Modigliani said, but they did make some assumptions. Remember, they assumed that there were rational investors, which we said isn't always the case. They also assumed there are no transaction costs, which we know that there are. And the big assumption they made was that there's no tax difference between receiving a dividend and between receiving share price growth, but there is. They'll be taxed differently, and in fact, with the share price growth, you won't be taxed at all unless you sell the share. And that's a big difference to investors. We also talked about the signalling effect. Remember, this is the signal to the market whenever you announce your dividend. What will the market think when you do that? If you announce a reduced dividend, they may think you're in financial difficulties. No dividend, they might think you're close to bankruptcy, whether that's the case or not. A rising dividend, again, they might think you're a strong business, even though you could have paid that out of reserves, no relation to earnings. The bird in the hand argument. Well, this was that investors want their return now. They don't want to wait for the capital appreciation in the share. They want their return in the form of a dividend paid now. The clientele effect. Well, this feeds into those tax differences that we talked about. Remember, investors will either want their returns in the form of a dividend, they'll be taxed as revenue, or maybe as capital appreciation. So what a business should do is have a consistent dividend policy, and in that way the investors can choose. So if they want a share where a dividend is paid consistently, well then they'll choose that share. As long as the policy is consistent, well then the shareholders know what they're going to get. The last thing we talked about in our first lecture was non-cash dividends. Remember, the first of these was a bonus or a scrip issue, and that was simply getting shares instead of cash. You maybe do that if you're a new business and you don't have the cash to distribute. A share repurchase, well, this is where you simply repurchase your own shares as a business. You might do that to reduce your size, or maybe to increase your EPS through having less shares to distribute your profit across. You may want to alter your gearing ratio, or indeed you may simply have surplus cash. But remember that the market doesn't really like you to use surplus cash in that way. They'll think that's there should be better ways to use your surplus cash. How will you undertake a share repurchase? Well, you'll either go through the stock market, approach your institutional investors, perhaps offer to your current shareholders. And that was the first of our ACCA F9 lectures. Remember, you can download this mind map as a PDF from our website, or indeed get the full course lecture there.